All right, welcome to The Explainer. Today, we're jumping right into the absolute high-stakes reality of the silver market right now. The silver squeeze, inside the ascending channel. If you've been glued to the charts lately, you already know we're in the middle of a massive, massive tug of war. I mean, the volatility is intense, the numbers are moving incredibly fast, and the pressure, it's literally building by the minute. We're looking at a hyper-dynamic situation where every single price tick is a literal battle between the bulls trying to force a historic breakout and the bears trying to trigger a massive rejection. So let's dive into what the latest market analysis is actually telling us.
Is the silver top already in, or is the real breakout just beginning? I mean, that is literally the multi-million-dollar question we're trying to answer today. We are at a really critical juncture here. Yes, the market has pushed aggressively higher, but it's met some fierce opposition along the way. When we pull back and examine the data and the structural analysis of these charts, we aren't just staring at random numbers on a screen. We are observing the psychology of the market in real time. And right now, you can literally feel the tension. Has the market reached its absolute ceiling, or are we just catching our breath before a massive surge?
$88. Just let the psychological weight of that number sink in for a second. Based on the most recent market data, the silver chart has pushed all the way up to this exact critical resistance level. $88 is the ceiling the market has been fiercely knocking against lately. It represents the immediate barrier, the literal wall that the bulls need to shatter to prove this rally actually has ultimate staying power. To understand exactly where we're going, we need to map out the current arena. Let's look at Phase 1, the resistance test.
So, silver is currently climbing this ascending price channel, right? But it has slammed into an active battleground. We're looking at a rejection zone between $86.22 and $90.77. The analysis highlights this specific area as a really thick blue resistance zone. Recently, the market pushed up, hit this wall of selling pressure, and was aggressively shoved back down. This isn't just a single point on a graph, it's a deep trench of resistance where sellers are heavily defending their positions against the buyers.
But of course, a market isn't just about how high it can jump, it's about how well it braces for a fall. Which brings us to Phase 2, defending key support lines.
Now, what's really fascinating here is the number 85.50. Because we're in that ascending price channel we just talked about, the lower boundary line naturally acts as our next safety net. Right now, that vital trend line sits right around $85.50. This is the absolute lower boundary of the current upward structure. If the price comes down and hits this line, well, that's the moment of truth for the bulls to step up and defend the channel.
But what if 85.50 breaks? What if the floor caves in?
Well, the analysis lays out a descending staircase of safety nets. It starts with a micro support, or the fib start, at $84 flat, which aligns perfectly with crucial Fibonacci technical levels. This $84 mark is absolutely vital because it's the last swing low. If we fall through that, the next key support levels to watch are 81.71, then 79.85, and finally, the ultimate floor on this entire structure at $78. These are the defensive trenches. If the bulls can hold the line at the primary trend or these support zones, the dream of higher prices is very much alive. Now, let's flip the script and look up. Phase 3, ascending channel price targets.
Crucially, the analysis points out there is currently no five-wave decline visible on the charts. That means there's no strong technical signal of a major top or reversal just yet. The upside potential is still completely in play. So, if the bulls can successfully defend those support zones we just talked about, where are we actually heading? Well, the analysis suggests it wouldn't be shocking to see us hit our first immediate upside target of $90.77 very soon. Notice that this is the exact top edge of that blue resistance zone from earlier. Smashing through that specific ceiling is step one for the bulls to regain total control of the narrative.
And if 90.77 gets breached, oh boy, the algorithmic targets just start lighting up. Based on the microstructures on those smaller timeframes, the next ideal target sits right around $95. This is rapid, high-tension territory, folks. A quick move to 95 means the ascending channel is basically functioning like a slingshot, just propelling the price straight into the upper sections of the macro resistance box.
And right above that, kind of simulating the intense pressure of a market just forcefully pushing higher, is $96.85. What's super fascinating here is that the data notes this trajectory closely aligns with what's being observed over on the gold charts too. If silver pushes directly higher and clears out those resistance zones, $96.85 becomes the next major magnetic pull for the price action.
But to really grasp the gravity of all this intraday noise, we've got to step back. Phase 4. The bigger wave picture.
The weekend update mapped out this macrostructural view that is honestly playing out exactly as planned right now.
We can't just fixate on the next $5 move. We have to look at the entire wave cycle to understand the true danger and opportunity lurking in this chart. Using Elliott wave structure, that initial move up is viewed as an A wave. Right now, we might be sitting in a wider B wave consolidation. But listen, here is the massive warning sign. Once the market hits the broader resistance zone, anything above $93.42, we could face a really sharp C wave rejection and decline. So while our immediate targets are pointing up, that macro ceiling above us is incredibly dangerous.
And this is exactly why following microstructures is absolutely crucial. By definition, these are short-term price patterns that guide our immediate targets. Why do we care so much about them? Because they prevent us from blindly predicting a major top before it actually forms. The market honestly does not care what we think the top should be, it only cares about what the structure dictates. Following these microstructures higher step by step is hands down the safest way to navigate this intense volatility. We don't guess the top, we let the structure show us the top.
In a market moving this incredibly fast, with descending support nets below us and aggressive upside extensions above us, it's so easy to overcomplicate things. But the core philosophy from the analysis boils down to this one simple quote. Just keep it simple. Follow the trend channel. As long as that ascending channel is respected, and as long as no 5-wave decline flashes a reversal signal, the most logical move is to just follow the trend.
So we've mapped the battlefield. The ascending channel is currently intact. The upside targets of 90.77, 95, and 96.85 are set, while those critical supports all the way down to 78 stand ready. But remember, that macro C-wave rejection is looming out there above 93.42. The pressure is building. The structures are drawn. Are you prepared for the next breakout or the ultimate rejection? Thanks so much for joining me for this explainer, and keep your eyes locked on that channel.
Disclaimer, this video for educational purposes only and not financial advice. Always do your own research.